Everything you've been told about how to handle losers in your portfolio is absolutely wrong. In fact, in this video, I'll show you how losers in your portfolio might be one of the biggest opportunities to make even more money in this market. And trust me, I know what I'm talking about. Over the past 18 months, I'm up 240% using very similar principles to what I'm about to show you in this video. I've invested in Tesla, Palantir, and the S&P 500. And as I mentioned before, I had a phenomenal 18 months. But that wasn't always the case. I've also had bad picks. I've selected stocks that have gone down in value, and I've seen red in my portfolio just like the next guy. And today I'll show you exactly what to do in these situations so you can actually make even more money. Now, look, it happens to everybody. Every single investor out there sees at some point stocks go down. We invest, we hope for the best, and then we get the worst. The stock drops, there's red, and it's absolutely normal. So the first phase of how to handle this is to understand that it happens to everybody. It happened to Warren Buffett multiple times. It happened to Peter Lynch. It happened to me. And it happened to every single person who has ever invested in the stock market. Nobody is shooting 100% from three-point land. Nobody has 100% success rate with picking stocks at any given moment. So first of all, lay off yourself. You're not that bad. We all have losers in our portfolio. But you see, in the short term, this is what most people don't understand. And when I say short term, I don't mean days. I mean 6 to 18 months. Within the next 6 to 18 months, the stocks in your portfolio might not necessarily be driven based on their fundamentals. And the price of such stocks will mostly be dominated by other factors, which are not the fundamentals, not the business, not the balance sheet, but rather emotions, sentiment, manipulation, media bullshit. There's a lot of that as well. But here's the thing. Price dropping in the short term doesn't necessarily mean that you have a bad stock on your hands. In fact, I'll tell you something else. Some stocks can be absolutely terrific, but see major drops in price, which if you think about it, creates a very interesting situation. The business gets better, the price gets cheaper. If the price keeps going down, but the business gets better, this is an opportunity to make money. That is an invitation for you to get rich, which is exactly what happened with the stock by the name of Palantir. When Palantir was at $7, I was making these videos telling you, hey, this stock is undervalued. They're getting better every single year, but the stock price keeps dropping down. At some point, the fundamentals will take over the sentiment, the manipulation, and the emotions, and the price will be driven up by fundamentals. The best friend of a great business in the stock market is time. As simple as that. And by the way, the worst enemy of a horrible business in the stock market is also time. You have to remember who you are, right? If you are a trader, a day trader or a swing trader, this video is not for you because these principles don't really matter to you. You buy a stock because you're hoping for the price to come up. You're hoping for the price to come down. If you're shorting it, the fundamentals of the company, the quality of the company really bears no meaning to you. In fact, this video is not for you. But as a long-term investor, if you have purchased a stock, then you've purchased it for one reason only, because you think the business is great and you think that this company can make a lot more money for you as one of the shareholders owning a piece of that company, right? So here's the question for you. How do you know, right, if a company is good or bad? Because you have to make a decision, right? If a company is going up in price and it looks in green and everything is phenomenal in your portfolio, there's not really a lot of decisions to be made there. I mean, that's easy, right? But what happens if you have a few companies, a few stocks in your portfolio who are in the red? Do you automatically sell them because they're in the red? Do you automatically double down because now they're cheaper? Well, the answer to both these questions is no. You don't automatically buy more because it's gotten cheaper, but you also don't automatically sell because it's in the red. If we have a stock that has gone down in price and the stock is bad, the company is no good, then we need to sell. But if the price has dropped, but the stock and the company are good, then we need to buy more because now it's cheaper. It's a very, very simple decision tree. So how do you make the distinction between the good stocks and the bad stocks? Because you have to decide, right, if it's good or bad. Do you basically do it based on a hunch, on a gut feeling? Well, my suggestion is that whenever you have a gut feeling, go to the toilet. This is science. So let's apply scientific principles. Now, I've devised a 12-step plan to look at any stock and actually figure out if it's good or bad. If these 12 steps are not the easiest you've ever seen, then you can unsubscribe after what I'm about to show you. But this is going to be very, very simple. Check it out. Number one, and you can write this down, right? Big market cap. Is this a small cap bullshit company, or is this a big market cap of $1 billion market cap or above, right? Number one. Number two, is the short interest of this company 3, 4, 5, 6%? That's okay. But do we have 11, 12, 13% short interest? Well, that's not healthy. A company that has double-digit short interest is usually, again, not for me. Number three, how good are their margins? Are they operating on a thin 3% net profit margin, or they have massive 15, 20% margins, right? How good is their revenue growth? Is the company growing every year, or are they declining? Do they beat their own expectations? And that's important, right? Every quarter, we have results from these companies. Every quarter, we have earnings. If you look at the history, and that's public information, you can find out over the past 4 quarters if this company actually beat or missed. And what you do is you basically look at the past 4 quarters of the company. And you look if it's a beat or a miss in every single quarter. Now, I can live with a company missing 1 quarter out of 4. That's okay. But if a company starts missing at a clip of 2 to 4, basically 50% here or miss, it's not for me. The other thing I want to talk about is cash versus debt. Cash is freedom. Debt is shackles, right? Companies love to talk about all the cash they have, but where's this cash coming from? From operations or from finance? Because if a company has a lot of debt, way more debt than cash, not interested. All of my investments have more cash than debt. Another thing is positive cash flow. I want to make sure this company makes money. If they're not positive in cash flow, not interested. Do they have a moat? Do they have a technological advantage that prevents other copiers from taking their business? Because otherwise, it's a commoditized business, not interested. Do they have ability to scale? Look at the ability of them to grow earnings and grow revenues without growing the expenses at the same clip. Also, look at seasonality. Is this a travel business? Is there seasonality? I'm not interested in seasonal businesses. That's garbage. I want something that works all year long. And of course, macro sensitivity. Do this company completely relies on the consumer strength? If we go into a recession, will this company continue to make money? Now, we're getting to the final and probably one of the most important parts. How good is the CEO? Because if the CEO is a bozo, again, I'm not interested. So how do we judge a CEO? Well, we'll look at all of these factors. For this, we have another 8-pronged test, which again will be quite simple. Number one, do we have a truly passionate CEO that absolutely believes in the vision of the company and is in love with the products of the company, right? It's a very tall order, especially in this day and age when CEOs basically change jobs every 3 years, but there's still people out there who actually meet this criteria. Elon Musk is one, Alex Karp from Palantir is another, but I'm assuming there's others. They're not the only 2 CEOs who meet that criteria. Number 2, are they hands-on? Do they understand every little facet of their business and are able to contribute and actually be a part of the process? Again, with Elon Musk, there's plenty of evidence of him walking up to teams in the middle of a workday and giving them suggestions, right? Number 3, do they have an infected culture, right? A culture in which all the employees basically rally behind the flag, right? Or do we have employees who come in for a 9 to 5? Not interested in that at all. So we want to make sure that the CEO is a total superstar, because if he's not, if he's just good, he's going to add average people to the business, and eventually that's going to eat the company from inside. But if he's a superstar, he's going to hire superstars. And of course, we have to make sure that the founder mentality is there. I mean, whether we have a founder still functioning as the CEO, which we have in Tesla and Palantir, by the way, don't give me that bullshit about Elon not being a founder, or at the very least, do we have a CEO that's been there for 10 years plus, right? That's just as good as the founder, right? Do we have CEOs that deliver on the promise, right? If they promise things, do they actually deliver, right? Do they beat earnings? Do they deliver the products they promised, right? And of course, accountability. Do we have CEOs that are able to say, hey, I made a mistake, that's on me, and I'm going to fix it? Mostly, you're going to see CEOs kind of dance around the accountability issue because they don't want to get fired. They don't want to take the blame. But a CEO that can stand there and take the fire on behalf of his men, even if he's not the culprit, is actually something I'm looking for. And of course, transparency. I want CEOs that are able to tell me what the hell's going on for real without all this political bullshit. For example, remember that thing when Elon tweeted, hey, the stock price is too expensive? That's the kind of CEO I like. Now look, these 8 tests actually combine into one CEO test, which is part of a 12-test program I just gave you a minute ago. If a company meets 6 out of these 8-prong tests for the CEO, and at least 8 out of the 12 that I just gave you a second ago, then it's a good company. If they fail to meet 8 out of 12, then they should be out. And if they should be out, well, the solution is quite simple. DCA out the same way you DCA in. It's never a good idea to go lump sum in. I always say this. If you want to buy a stock, buy it slowly over time. Don't just pour all your money at one single point. The same principle applies on your way out. If you're trying to get rid of a stock, do it slowly in a DCA manner. Basically getting rid of a little bit and a little bit every time, riding the price, because you never know what's going to happen in the price short term. Remember what I said. And we actually teach all these principles and much, much more in my academy. The Heroic Academy is designed for people who want to take the time to become long-term investors. If you have the time, the desire, and the financial ability to pay for this, because this is $99 per month, you're welcome to join the academy. But if you've lasted this long in the video, I'm going to let you know, we have a special $35 price, 1/3 pretty much, for the next 12 hours. Go get it right now, and I would love to see you in the academy. But as always, don't forget, don't click nothing, don't smash nothing, don't buy nothing. I'll see you in the next one. Peace.